Good morning and good afternoon, everyone. Thank you for joining us today. My name is Jonna Emke, and I'm the Senior Marketing Manager here at CoreLogic. I'd like to welcome you all to today's virtual panel, Moving Ahead on Climate Change, Tackling Climate Risks in Financial Services and Insurance. To ensure our best session today, I'd like to cover just a few housekeeping items. All attendees will be muted to avoid background noise and minimize any panel interruptions. Our panel today discussion is estimated to last approximately 60 minutes, plus we'll have 30 minutes of interactive Q&A at the end. We welcome and encourage our guests to ask our panelists questions. Please submit them through the Q&A box on your screen. If your question is for a specific panelist, please include their name followed by their question. We're going to do our best to answer as many questions as possible in our 30-minute session. To optimize your view of all of today's panelists, simply click on the square button in the upper right-hand corner of the video section to activate the full screen view. If during the discussion you want to submit a question, simply close the full screen view in order to see the Q&A box. Today's session is being recorded and will be shared via email after the event. Now, on with our show today. I'd like to introduce Milena Malav, General Manager for Financial Services and Insurance Asia Pacific here at CoreLogic. Milena will be kicking off our event and introducing you to our panel of experts.
Thanks for the introduction, Jonna. And good morning, everyone. The past decade has shown us clearly how vulnerable Australia and New Zealand are to natural disasters and the vital role financial and insurance sectors play in helping to get people back into their homes and our communities and cities rebuilt. The increase in severity and frequency of natural disasters is real, and unfortunately, it's no longer temporary. Financial and insurance industries are particularly exposed to the cost of these climate changes. Today, we are bringing together the industry for a discussion led by experts in this field to examine how the financial and insurance industries can mitigate climate-related financial risks and embed climate change as part of their strategy and risk management framework. Now, I'd like to introduce today's thought leaders and climate experts. Tim Grafton. Tim is on an executive committee of the Global Federation of Insurance Association and is Chief Executive of the Insurance Council of New Zealand. He was part of the technical working group that developed a sustainable finance roadmap for New Zealand. Welcome, Tim. Jackie Johnson. Jackie is an advisor to the IAG board on climate change and sustainability and a non-executive director of Community First Credit Union. She is also co-chair of the UNEP Financial Institution Global Steering Committee, co-chair Australian Sustainable Finance Initiative, a member of Chief Executive Women, and a member of Resilient Sydney Steering Committee. Welcome, Jackie. Ernst Rauch. Ernst is Munich's Chief Climate and Geoscientist and Global Head Climate and Public Sector Business Development with a professional background in geophysics and meteorology. His expertise in the climate domain include risk management solutions for climate and natural catastrophes risk and energy transition related technologies, renewable energies, and energy storage systems. Welcome, Ernst. Zoe Witten. Zoe is an executive director at Pollination Group, a specialist climate change investment and advisory firm, and a board member of the Investor Group on Climate Change. She previously led the APAC ESG research team at Citi, covered climate change at Credit Suisse and at Bank of America Merrill Lynch, and worked as an analyst at the Oxford Smith School and the Stockholm Environmental Institute. Welcome, Zoe. Dr. Pierre Viard. Pierre is a senior global risk transfer director with 2 decades experience in all aspects of risk transactions, including reinsurance underwriting, natural catastrophes risk management, structured risk, and fund management. Pierre leads CoreLogic's consulting and risk management team in Australia and New Zealand with a focus on climate risk and risk management solutions for the insurance, banking, and government sector. Welcome, Pierre. And finally, our moderator today is Tanya Fiedler. Tanya is a lecturer in accounting at the University of Sydney Business School and a researcher at the Sydney Environment Institute. Tanya has significant expertise in carbon markets and climate change and conducts research that seeks to understand how engineering and climate models can be translated into financial information. Tanya previously worked for the climate and energy consultancy Energetics. Welcome, Tanya. Thanks again to Tanya and today's panelists. We are looking forward to a very informative and spirited conversation today that will help our guests better understand, manage, and prepare for future climate risks and understand how they impact businesses, customers, and our communities. I'll now turn it over to Tanya to kick off our panel discussion.
I think I'm on air now. Well, good morning, everyone, and thank you very much to you, Milena, and CoreLogic for inviting me to chair this panel. And welcome to the speakers and also to you, our audience. Many of you are likely aware that following the global financial crisis in 2008, the Financial Stability Board was established to assess vulnerabilities to the global financial system. One of the vulnerabilities identified was climate change. And from this, the Taskforce on Climate-Related Financial Disclosures, or TCFD, was convened. In 2017, the TCFD released its recommendations for climate-related disclosures, including recommendations to describe in mainstream financial filings the organisation's climate-related risks and opportunities, the impact of these on the organisation's business strategy and financial planning, and the resilience of the organisation's strategy to these impacts. Now, the types of risks and opportunities considered in these recommendations include those relating to transitioning to a low or even zero carbon economy, those relating to the physical impacts of climate change itself, and those relating to legal and compliance risk. Research I've been involved in with a number of climate scientists, and that will soon be published, demonstrates, however, that physical risk in particular is challenging, as the climate models developed by climate science were built for the purpose of scientific pursuit and to assess the impact of increasing emissions at global, continental, and sometimes regional scales, but not for the purpose of assessing risk at the level of an asset or its operations. Now, global reinsurers such as Munich Re have many decades of experience in using the information climate models provide simply because their core business is to transfer risk, including the risks from climate change, from the balance sheet of others to their own. And from this, an emerging practice of what you might call climate analytics is beginning to evolve to address the research business gap. And it's this emerging practice that we're here to discuss today. So I'm going to put my first question to Ernst. Given the wealth of experience Munich Re has in this area, could you perhaps identify for the audience some of the key challenges and issues that you see for the finance sector, and perhaps focus a little on TCFD?
The old story in the digital world now, and the word of the year, you have to unmute. So first of all, thank you very, very much, Milena and Tanya, to you for the very warm introduction, and to CoreLogic for the invitation to speak here at this webinar this morning. And also a very warm good morning from Munich in Germany to all of those who are participating this webinar today. On your question, Tanya, as Munich Re, as a reinsurance company and risk management company, indeed our DNA is on understanding, measuring and managing risks. And one of the core areas of expertise which we are having since more than 100 years is on natural hazards. And in order to deliver on this business model, we have started collecting detailed data and running analysis of the data of natural catastrophe losses worldwide since the 1970s. So that's about 50 years of data. And what we have observed already decades ago, and that was the starting point of our work on climate change, was that in some regions and with some natural hazards, obviously probabilities and probability distributions have started to change. And so we think it's absolutely reasonable and the right questions TCFD and regulators are asking on the question of managing the risks from climate-related exposures, and of course, prior to that, measuring this. So we have started developing methodologies, models, and tools to quantify this risk of change driven by climate change many, many years ago. And we use this internally as a reinsurance company to underwrite our risk, to provide a price tag ultimately on these risks. And we did this initially with a view on the present hazard situation. So the probability and intensity, for instance, of floods occurring at a given location. Over time, when we realized that there is a risk of change coming from climate change, we have started to work together with the IPCC, the Intergovernmental Panel on Climate Change, in order to implement scientific knowledge and data ultimately into our models, which also allows us to have a forward-looking view on the risk situation. Now the challenge, and this was the question, Tanya, you asked, the challenge which we have observed is that the language of the scientific community, so the IPCC language and the scenarios climate models arrive at, RCP scenarios, for instance, this is pure science. And it's not easy, not simple, not straightforward to apply these scientific models to the needs of the financial service industries, insurers, banks, asset managers, who have to answer the question, what is going to happen under a warming scenario for 2 degrees, more than 2 degrees or less in a certain year's period of time. So we started developing skills to translate scientific language into the language of our industry. And based on this, we now also help our clients and provide certain services. And that's an area where companies like CoreLogic, but many others have jumped in to deliver on the needs, on these pain points which we have realized in the financial service industries, to understand what the scientific scenarios are meaning and translate it into languages of our industry. But the translation is not enough. Ultimately, when we need to report according to TCFD, or when we want to steer our portfolio, for instance, according to changing risk patterns, we need to have certain tools, software systems at hand, which allow us to run these analyses on standardized methodologies. We at Munich Re have done this. We used these models internally for our own underwriting purposes. We are now offering this to our clients in the banking industry, to asset managers and others. And that helps these clients in the financial service industries to really ultimately understand their risks, which they have, for instance, in mortgage portfolios or in real estate portfolios. Forward-looking risks for the next 10, 20, 30 years. And we do this analysis now until the end of this century. And that's a major step forward, and not only usable for TCFD-related reporting, stress tests also in the future, but even more so usable today to steer and optimize portfolios. So these systems, we have developed a scoring system, climate scoring system in our software systems, allow, for instance, to compare location by location based on the present probability of flooding or wildfires in Australia, and analyze what's going to happen within the next 10 years and see whether different locations show different changes or so. So that's really the power of these systems, And I'm quite confident that such systems and tools, methodologies will have further use in the future, and services based on this as well. Thank you, and back to you, Tanya.
Chance. It sounds like fascinating work that you've been involved in, and I'd love to discuss it more another time. Pierre, could you maybe tell us, so Ernst was just elaborating on some specific hazards, such as flooding, but we know, climate scientists know, and climate professionals, they're aware of the systemic nature of climate risk. So could you perhaps elaborate on how you see these systemic risks from climate change affecting the sustainability of the insurance sector and the finance sector more broadly as well?
Yeah, thanks, Tanya. Yeah, systemic risks is indeed an important component of the possible impact of climate change. Obviously, the full impact of climate change is not fully understood, and as Ernst alluded just before me, he said that understanding the impact still require a lot of efforts and understanding of the models and what it means. So it's a work in progress. But what we've learned so far from the insurance industry, where they've been facing natural disasters, is that we know that it affects obviously properties, home and businesses, but it also affects communities. So often when a disaster occurs, there would be results in very large insurance bills, which are often supported by the local and international capital, and also the capital markets. But for the communities, it is translated into a drop in vacancy rates, an increase in delinquencies, and often an increased demand for resources. Now, should the impact of climate change increase these trends, increase the effect of natural hazards, we know that certain communities currently are being new risks are being identified, such as coastal erosions, like in the Waitaki district coastal zones in New Zealand, but also in urban centres like in New South Wales, in Sydney, around Narrabeen, or the impact of bushfire if they are even bigger in the future, or in fact the northern part of Queensland with the impact of cyclone risks. So in order to help the communities, I think the insurance industry already stepped in order to help onto the resilience aspect. And talking about cyclone, it's an easy example to understand. It is to help communities to have better housing, understand the roofing, the anchoring, all this information about where they live, and help them improve those buildings. And that's very much the resilience, helping community to adapt to future risks. And understanding this information from the properties to the natural hazards is a key component to improve and support the society in general. So I will give it back to you, Tanya.
Okay. Yeah, look, thank you very much for that, Pierre. The other day, Jackie, we were discussing, so you had, in addition to the examples that Pierre has given there, you gave some further examples of the systemic nature of some of these risks. And we spoke about the compounding, or I think you said aggregation of risk, which has the effect of accelerating risk. Could you share with us some of those examples that you provided of such risk acceleration? And What would also be really interesting to hear is what, in your view, does this mean for the assessment of risk as a practice and for the management of risk, indeed, at the board level?
Thanks, Tanya, and I'll be building on a little bit of what Ernst and Pierre have just covered. When we think of risk, I think as risk professionals and leaders, we need to start thinking about the impact of three key things. And one is the connectedness of risk, which I think has been brought to life by Ernst and Pierre. But in our models, we've been taught to think about impact and likelihood, but it's usually on one risk at a time. And really, when you think about the velocity of risk, so climate change, we think about 2030, 2050, but the velocity of climate change risk accelerates when it comes together with a different risk. And I'm thinking, and Tim will smile at this because we worked together in Christchurch after the earthquakes, which, you know, the first earthquakes and the major earthquakes now 10 years on. But the learnings from there is when you've got a geological event that land slips and sinks, and, you know, in some parts of Christchurch, 1.8 metres below sea level, that means all the climate models need to change, because actually the climate risk has now shifted because of the geological risk and event that happened. And I think Pierre brings a really important point about community, because the biggest risk to New Zealand was, one, not being able to secure capital, such as reinsurance capital, but also depopulation. If people could not get banking services or insurance in that community, then you've got a bigger risk for that whole community and New Zealand as an economy and a society, where there's depopulation just because they can't insure their homes. And so it then brings me to the other piece about the connectedness is also about sectors having to work together, which comes together about the systemic risk, but also the global interconnectedness. And if we think about what we're seeing at the Australian Sustainable Finance Initiative, it was the fact that the investors, banks and insurers came together with the regulators to look at what the financial roadmap needs to look like, both in Australia and New Zealand. Tim played his role within the New Zealand initiative. But it was also connecting in with our global networks to understand what is happening, because we are physically an island, and so is New Zealand, a series of islands, but in fact we are connected in capital and we need to play our role. So I think as risk professionals and leaders, we need to connect those. And I think Ernst and Pierre has talked about modelling. I think classically what we've done is Ernst brought to life about we need to look forward. Traditionally, we've looked at past events by looking at the physical science, but we need to combine physical and behavioural science, which leads me to the other example, Tanya, about when we think about COVID-19, we're thinking of that as a health and an economic crisis. But the reality, behavioural patterns are now changing. So people, Pierre called about, you know, the coastal risks in Australia and New Zealand. Well, people seem to be migrating to more and more sea change as we've gone through COVID-19 and working from home opportunities, which means that aggregation of risk shifts. So it might alter the trajectory of increased rainfall, fire, flooding, and we need to consider those in our models. What are the behavioural things happening in our society that comes together to look at impact and likelihood of a climate event, and what the impacts will be in the shorter term than what we might have previously thought about. Your other question about board and executives and risk professional leadership, I think we have to really change the way we look at scenarios. I think we need to bring together all those things about what are the behavioural and the physical risk, and what is the intersection of different risks, and play those out in scenarios. And really think about, I don't think we can ever use a previous event as the likelihood for a future event. I think we have to say, and some of the work that was done in Christchurch with small business was organisations that had really good risk management, business continuity planning, only did well if they taught the leaders how to make decisions. And there's a lot of academic research, as you know, Tanya, about the more you can localise some crisis management, the better decisions for the community, but you also need leadership at the most senior level to know about the trajectory that's 5 to 10 years out. How do you recover from that risk? And Christchurch, a great example that they can continue to access the reinsurance market. And also as board members and as executives and senior leaders, how do we keep our knowledge current, broad, and not anchored in the beliefs and experiences that we came through our career? Because the future is changing. And if we just use past experiences just to anchor all our knowledge, then that's not going to help us adapt. And what Pierre was talking about is help communities adapt and be resilient. So I think ultimately, when I think about the Australian Sustainable Finance Initiative, the top 8 of our recommendations are actually about leadership in practice for sustainability. And we have to take accountability ourselves on that. So I'll hand over to you, Tanya. They'd be my thoughts on the connectedness of risk.
Jackie. Really fascinating discussion there around the need to combine physical and behavioural science. Now, Zoe, you've got considerable experience in the area of, trying to translate physical models into tools that can be used by non-climate professionals for the purpose of valuing risk. But we now also hear about from Jackie, the need to also include behaviour change, etc. And then Ernst also spoke about the translational challenges in the language that's used, say, by science, and the need to translate that into business. Can you elaborate a little on these translational challenges that you've experienced, say, from the investor perspective, and what would be really interesting to hear, and this was something we were discussing the other day as well, is how the flow-on effects of these compounding or aggregated risks that we're hearing about, how material are they to the finance sector, given that they're difficult to measure and understand? What does that mean in terms of these translational challenges?
Good question. All good questions, as always. Excuse me. So let me, as you said, there's two pieces of conversation there. Ernst just talked very clearly about the difficulty that you have translating from physical information through to financial information. I'll dig into that. And then Jackie has talked about this kind of compound risk issue. And as you say, the materiality of the compound risk issue is an interesting topic to discuss. So I'll touch on that as well. On the first one, just to give some examples, as you said, about those difficulties in translation, we would very regularly find ourselves having conversations with, let's say, science agencies or specialists who would say, look, I've done some incredible, world-moving work as far as building physical models that are sufficiently detailed, that are sufficiently granular, that are usable, and I've packaged them into something which I think is, A, from a scientific perspective, as simple as anything and almost unuseful because it's so dumb, but B, also looks really accessible and usable to a lay audience. And now I would like to take it to a corporate community or a business community and see if they would like to use it. And the thing I always found remarkable about that, being in the community that was trying to do valuation work, is just they had done so much work to build that tool that was going to be usable for commerce, and it would still be so far away from something that we could use for valuation. And I think that's because, the distance between CSIRO and an investment bank is actually a very big distance, human capital-wise, language-wise, expertise-wise. And what we're trying to do when we do the translation work is actually bridge that distance. And we don't have that many people who are familiar with both sides of that, or even wide sections of that spectrum. So you're trying to bridge a very large spectrum, and often you don't have the people to do it. And what I should say about that, a really good example actually, is transition risk. So we've known about transition risk for more than a decade. And people often look at investors and say, why are they taking into account? Why are they still buying the things? Why are the prices of the coal companies still anywhere? But we've known about transition risk for almost a decade, but we almost still cannot price it. Pricing is a high evidence exercise. You're doing it in a market with a lot of people who will shoot you down if you don't get it right, and you're asked to have a very good case when you make a price. And so you need really good information, you need reliable information, and often that information is historic, because that's where you get good, reliable information, generally from precedents. And so even transition risk, which is a lot easier than physical risk, is still exceptionally difficult to price in a financial market. So that's the first thing I'd say about that translation from across that wide spectrum. Now, if we get on to Jackie's point about compound risks, which is a really, really important example, I want to give a few examples of why compound risk can be so material and also so hard to forecast. And I want to give you 3 examples of just very simple compound risk that might make the point. So the first is one that Bette Dawson brings out when she talks about city resilience, and many of you might have seen it. It's this great photograph. It's a picture of a car manufacturing plant in Turkey, and the car manufacturing plant is untouched, pristine. You know, it looks like any other day in the week, and the entire surrounding area is completely destroyed. It's been destroyed by an earthquake, and the car manufacturing plant is it's fine. It could keep operating. But the people who work there can't get there, and they can't get any of the cars off the plant. So it doesn't matter because the surrounding context is being destroyed. And it's an example of, if you were analysing that asset and you'd say, have we done everything with that asset that we could think about in order to protect it? You will probably get the answer that yes, we have done everything we can do to protect this asset. But because you haven't been able to protect the surrounding system, the risk is still alighted on the asset itself. Now, another example of, I guess, a related or a connected compound risk is COVID. So one of the interesting conversations we had in our organisation when COVID started was we sat around and we said, wow, this is huge. Why didn't we think of this? And of course, no one thought of it. So we were just being arrogant. But nonetheless, we did say that. And the thing that we came to is a lot of people said, look, we knew there might be a pandemic that we've been talking about for ages, but what we didn't anticipate was a quarantine. So it's the quarantine in many cases that is really doing a lot of damage. It's the response trying to preserve human life that is really making the huge economic impact. But had we looked forward, and we did look forward and go, what would the price of a quarantine be and what would it mean? We would have had to anticipate the response and the behavioural response as well as the event itself. So that's another example. And the third example is just the fires, right? Because you can look at Sydney and go, fire zones, you know, is it exposed? How do I anticipate the temperature will change? Are we going to have a fire event in Sydney? And go, well, probably not. But it doesn't matter if there's a fire event in Sydney, if there's a huge fire event around Sydney. And what does that mean in the long term for the accessibility of the city, for the property prices, for people who want to live there, and for human movement? So that's those 3, I'd say, are really good examples of how a compound event can make an event much more significant financially than it would be by itself, and also how difficult they are to anticipate. And so at the moment, we talk about physical climate risk modelling and we say we're not very good at modelling flow-on effects and tipping points. I would say in the financial system, the corollary of that is that we don't know how to model compound events in the financial system. So at the moment, as with physical climate models, that is something that we can't see. We're doing all of our risk analysis, but there's a big bit of it, probably the damaging bit, that we can't actually observe yet.
Okay, thank you very, very much, Zoe, with some great examples there, which leads me now back to, well, either Ansel or perhaps Tim, if you wouldn't mind talking to this. So Ansel spoke earlier about the capabilities Munich Re and other reinsurers have developed over the last few decades. But we're now hearing about these issues associated with behaviour, as well as these compounding of risks, many of which, as Zoe just pointed out, we can't necessarily foretell. So then the question becomes, well, who does this translation work? So is this translation work something that should be done by climate scientists? Clearly, there's a piece of work there that needs other input, or should it be done by financial analysts, as Zoe has been involved with, or do we need also behavioural scientists, or are there future thinkers that need to be involved? How do we actually get this work happening, and who does it? Who are these intermediaries who enable this translation work? So Tim, perhaps to you first.
Okay, just confirm you can hear me?
Yes, we can hear you.
Good. Thanks very much. I think what we've heard so far are sort of key concepts around interconnectivity globally. We've heard about forward-looking projections, and we've talked about identifying physical risks, but also we've got to start to dig into other implications. So when we had the 2012 Southeast Asian floods, chip manufacturer globally was affected. It affected the cost of technology, and that was just one example. I can give you a local example in New Zealand when we have coming into summer the snow melt and Lake Wakatipu starting to rise. It's not the physical damage so much that causes the loss, but it's the business interruption. The tourists aren't coming, and as Jackie referred to Canterbury earthquakes before, educational facilities started to lose students for a number of years. So the economic and the deeper costs of not getting this right and not thinking more broadly and deeply are absolutely ginormous and have huge implications, which kind of leads also not just to a climate change analysis, but a broader ESG, environmental, social and governance analysis because of the interconnectivity of all of these issues. But that's another conversation perhaps we could come to later. But to answer your question, obviously when we're talking about cross-sectoral issues, the answers are collaborative efforts. It is not just the scientists, it's not just the financial sector. It also requires a number of entities to be part of this mix. For the past 3 years, I was the chair of what was called a users group. We were end users, insurers, agricultural sector, other sectors involved in a science research around climate change adaptation. And our role solely was to talk to the scientists to say, this is what we want. We don't understand the science, but we'd like to know this so that we can assess our risk. And similarly for the scientists, this was I guess, an enlightening moment for them to understand, well, this is the real world practical outcomes that we need to be gearing towards, and we can explain what we're doing and how that might contribute. So there has to be a coming together at that point as well. But the critical issue is, how do you translate this through so that you get the right price? Because if you misprice climate change, then you affect investment everywhere. And if we're looking for a smooth transition to a low-carbon, sustainable global economy, then those investment signals have to be as precise as possible, albeit recognizing those huge uncertainties that we've already covered off today. Just on science, I'm aware of the Climate Measurement Standards Initiative, which in Australia, which has involved science, banks, insurers. And my understanding from that exercise was the finance sector says, hey, you make the decisions on what the most appropriate RCPs, so just sorry if I'm using a bit of jargon there, but the RCPs are the representative concentration pathways. In simple terms, what level of greenhouse gases lead to what level of temperature change, likely temperature change, so scenarios around how that plays out. And here in New Zealand, just recently, we've had the Climate Change Commission, which has a mandate to recommend emissions budgets going out to 2050 to achieve our zero carbon targets, has put through sets of scenarios where the science is setting the kind of parameters of the possible worlds ahead that we have to make decisions on and how to navigate through that. And clearly under the TCFD framework, there is a recommendation for what they call the lowest, RCP 2.6, which is to look at a achievement of a 2 degree below 2 degree world versus for insurers looking at a higher level of risk going through to the end of the century. So there is a are coming together there, but also fundamentally regulators and government, and Jackie referred to leadership at the board level. All of these things are absolutely critical. So, you know, in terms of regulators regulating the financial sector, there's a lot to be done there. The green taxonomy, you know, how do we classify certain activities as being green and validly green? And that's undercooked and undeveloped. It requires to be put in place. There's a shortage of sustainable investment grade assets that are green proportionally to where the investment is happening. Regulators, what are you doing about that? For a life insurer with a long-term investment, the challenge is there is that the longer your investment, the higher the risk attached to that by the regulator. Well, how are you going to have long-term green investment if the regulators are going to penalize you for that? So regulators, smarter thinking around that's going to be needed as well. And also, you know, just supporting citizenry to have a smarter financial sense of, you know, what is sustainable, what we need to do, because, you know, they are ultimately the drivers of opinion and where investment goes. So I think there's a whole lot of things there. And the final point I'll go before we go on to the other questions is that for insurance, it is absolutely essential that risk-based pricing reflecting the climate risk is allowed to send that signal. Governments and regulators that seek to mute or hide that lead us into an unsustainable world. And that there are other ways of addressing affordability and availability of insurance, and they come down to the issues around mitigation and adaptation, and that's where the focus needs to be. And if the support for those vulnerable in the community who cannot afford cover, then there are other mechanisms than muting that price signal, and that is something that regulators and governments around the world need to take heed of.
Thank you very much, Tim. The experiences you were relating there in New Zealand and also in Australia here about that collaborative work between science and finance is really, really interesting. And on that, Pierre, could you maybe just tell us a little bit more with regards to your own experience as to how different components within the finance sector, so for example, how the banks versus the insurers versus investors are currently dealing with climate change as risk. Many of them are already disclosing their exposure to the physical risks of climate change. Would just be good to hear more about how you feel insurers can help others as well. Thank you.
Yeah, thank you, Tanya. I mean, it's a fascinating discussion, by the way, and it's true that it would be good right now to precise or to define what we call the finance industry, and the finance industry has many obviously sectors, but there are three clear sectors that are linked to the finance industry. There is obviously the insurance and the reinsurance sector, which are taking on those risks. There is the banking sector, which is facilitating and helping the overall housing finance ecosystem. And at the end of it, there is the investment sector, which is not directly perhaps linked to it, but in fact, it is supporting all of this activity. So let's be quite clear. There might be a bit of counterintuitive view on what would be the impact of climate change. Often we think climate change, it has to be the insurance which is the most affected. And it's true, they are. But insurance is able to adapt and to review the assessment of risks on the the insurance and the reinsurance are very good at trying to understand and follow their customers and see their needs and see what evolves. So in that respect, insurance is quite reactive, insurance and reinsurance. But on the other hand, for the banking sector and the investment sector, they're in fact a bit more affected by climate change because they hold the assets for a longer period of time. Their investment views are way bigger than just a year or 2 years or 3 years. they are holding risks for 10, 20, 30 years when it's a mortgage. So climate change in that respect is extremely relevant to their business. Now, it's true that it's fair to say that the insurance and the reinsurance sector are more adapted, if I may say, are not adapted, but at least they are more aware on how to evaluate those risks. They're using models for a long time, and, trying to price the best they can in order to integrate the various risks, the natural hazards, and to compound at least those risks. But it's true that for the investment and banking sector, it's time for them to bring on, if you want, this kind of knowledge, intelligence into their view of, into their long-term portfolios. So it's interesting how, in fact, it's the right time now to bring on that knowledge, to have a more, perhaps, at least an educated view on what the risk could be or might be becoming. So it's always good to be prepared. And just to put things in perspective, imagine if 20 years or 30 years ago, should we have had those information already, and perhaps the communities which are currently suffering from increased natural hazards, from I'm thinking of bushfire, coastal erosion, flood, obviously. Obviously, if 30 years ago we knew, or we would have had the information, the data to appreciate the impact, and obviously we would have a better outcome for these communities today. So it's really time to integrate that. And I do understand and hear from Zoe that it's true, there's a compounding of risks and one on top of the others, and we cannot think of everything. But it's good to start somewhere. It's good to start to flesh a little bit of understanding of these risks onto those portfolios that everybody is holding.
Yeah. Pierre, can I just ask you quickly, so if others within the finance sector are trying to understand these risks, what's the first thing that they should do? Should they go straight for a big scenario analysis of their physical risks, or is there something else that they should do first?
Yes, there are many steps actually of what can be done. Sorry, there are, as you mentioned, we can start with a scenario and see what it means effectively to the portfolio. And let's think of an investment portfolio where we do have a lot of real assets, and we don't know where to start because those real assets, there might be infrastructure project, there might be insurance-linked securities, but ultimately all of these assets are a property. And when it comes to property, there are a lot of data out there to identify where they are, what they're made of, and what they're the most likely be affected by. So it's true that there's a whole suite of solutions to address, but I think, and depending where you are in your journey in understanding those risks, if you have not done it before, then let's start with the first step. That's to assess through a scenario what it means, what do we learn, and what do we need to do next? Does it affect my portfolio? Should I change my strategy? Should I communicate differently to my customers? So those questions are very much what you learn from these steps. And then, as you evolve in your understanding of the risks and your relationship with your customers, you might want to be more and more sophisticated.
Thanks, Pierre. Zoe, I'm going to play a little bit of Pierre, there's many people understand scenario analysis to mean many different things. And there's also the term stress testing that people use. And I was just wondering, Zoe, in your experience, is stress testing something you have found to be more helpful, or is it scenario analysis? Yeah, just good to hear in terms of the work that you've undertaken, and particularly around the exposure for banks.
Yeah, absolutely. So I guess if I start with the difference between scenario analysis and stress testing. So scenario analysis, Pierre's been describing, you have a series of scenarios. They're described by a series of factors or measures. So in this scenario, gas prices are going to do X, or sea levels are going to do Y. And you basically collect them up into different versions and then test a portfolio against them. And stress testing is when you say, look, I'm not going to try and imagine what the future looks like. Instead, I'm going to try and think about not the worst, but an appreciably bad outcome that could happen, and I'm going to stress test the portfolio against the bad outcome. And so, of course, that's really, really common in insurance. It's really common in risk consulting. It's something that financial sector's been doing for yonkers in other expressions. And actually, Pablo Baruti has a really good way of talking about the two of these. He says, when you're doing scenario analysis, you're trying to come up with versions of the future and then think about how they might affect you. And sometimes when you're doing stress testing, you're trying to understand where the thing that you own will break. And so sort of quite different approaches there. And so Pierre's been talking about scenario analysis for use in financial services and investments. And everyone has been doing a lot of work, as noted, in scenario analysis for individual assets, for portfolios, for quite a number of years now. But when we started doing a lot of scenario analysis, there were a few things that we noticed that were hard. And the first one is that doing scenario analysis in aggregate was often quite challenging. So we at the moment help a lot of investors looking at individual assets. If you own a shopping centre or a port or something, then you can look at that asset and go, I can actually understand in this scenario what that might mean, and I can get an attachment to this asset. And this is relevant for transition risk or physical risk, right? So in both of those cases, you can build a really serious scenario around an asset. But when you have 4,000 exposures to companies in an equity portfolio or a universe, and in addition to that, each of those companies might have anywhere between 2 and several thousand assets, doing scenario analysis on that volume starts to become logistically and analytically a very serious challenge. And the second difficulty that we were having with scenario analysis is that for a very good reason, everyone went away and said, I'm going to do scenario analysis, I'm going to learn about climate change, I'm going to push that knowledge across my organization, and then I will disclose my results to the financial market or to my finance provider, and that will mean something to them. And the first part of that process worked relatively well. So people use scenario analysis very usefully to learn about climate change and to build that understanding across their organizations. But the second bit, where they tried to pass it to a central financer or a market or whatever it happened to be, and say, guys, you know what to do with this, right? Was an absolute mess. We had scenario analysis being produced on 100 different methodologies, and as Pierre knows, the number of scenarios available are multiplying and multiplying and multiplying. And so the idea of comparability just kind of went out the window. And that problem will address itself over time, right? In as much as we will develop best practice in markets, we will start to get to a point where people have enough scenarios that they're comfortable with, that there are a few central ones that do everything we need and that are accessible and stuff. But in the process of going through that, we did get to a point where a lot of our investors were sort of saying, well, look, we know that it's possible that coal prices could drop 20 or 30% by 2030. We know it's possible that gas prices could move 10% up or down in the same timeline. So how about we look at our portfolios and flex that and just ask, and we can just look at every company that we own or every asset that we own and flex those things. And then we understand relative exposure. And so that we don't have to be in a situation where every single company is giving us a beautiful scenario analysis that's completely different to the one next door, right? And so that's where the stress testing thing started to come in. But what I should say is that stress testing still works relatively well, and it's used by regulators increasingly on climate change. Insurance regulators in the UK were the guys who started, but now more and more people are using this kind of stress testing approach. Works quite well on transition risk because you can move energy prices around, you can move water prices around in the system and see what the model kicks out. But it's still difficult on physical risk because you still need a lot more information. If I just say, look, sea levels rise this much, I still need to know where everything is in the portfolio to understand what that means, right? So trying to think about physical risk is still difficult in those big aggregate systems. And we're starting to use the types of what we did with transition analysis is we said, look, I can't calculate every single exposure of every utility asset in Europe. But what I can say is that on average, utility assets are exposed by this much. And so I'll look across my portfolio, I'll find the concentrations of assets with possibly large exposures, and then I'll do deep dives there. That approach also, it works better for physical risk as well, to say, look, I've got broad ideas of what the risks are. I'll roll that across the big portfolio, and then I'll do deep analysis where I see really high risk areas. And so that, I think there's quite a few pathways there that lots of people are pulling together, and we're making a lot of progress. I will still say to Jackie's earlier point that the compound risk thing is monstrous, right? And largely invisible in many respects. So, what is the wider economic impact of climate change generally? What is the political impact of a water shortage? What is the political flow and impact of a consequent refugee crisis? What happens if you get civil unrest in a region because of the water crisis or because the water unavailability knocks on to food prices, which is what we've seen in Northern Africa, right? So we know those things are there and we know they're extremely consequential, but those types of events, scenario analysis, you can start to get close to them if you use qualitative scenarios, but they're still very difficult. Yeah. And I would say, generally what we're doing is we're moving from an atomistic model of analysis in financial markets and in risk, where we would say, I can analyze every single thing individually and then I will aggregate up and I will know risk. Yeah. And we're trying to move now towards a systematic model of risk, right? And we do have some really good models for that, but we are combining that with a climate system that's quite difficult to measure, actually. So we're going to need lots of new tools and frameworks and probably help from Ernst and Jackie.
Yeah. Thanks so much, Zoe. This is such a big and complex conversation, so really appreciate those insights. We're running low on time because I just want to make sure that some of our audience participants get the opportunity to ask questions. Before we go there, though, perhaps quite quickly, Jackie and Tim, if you could describe to us, so we've got two different governments in Australia and New Zealand, and they're taking different approaches, or the regulators are taking different approaches with respect to demands they're placing on the finance sector around climate risk and climate risk disclosures. So the one is principles-based, the other one rules-based. Could you maybe each just very quickly talk to the challenges in those different environments? Jackie, maybe if you can go.
Yeah, I'll kick off. I'll kick off. And having worked in both jurisdictions, I think the other reality is in Australia, we also have 3 tiers of government. So some of the not so much financial regulation, but the intersection with the financial sector happens at a state government level. And I think about the sustainable finance discussion is happening with state treasury, who are also helping create some markets and look at the adaptation issue that Tim spoke about. So I think it's very important that we highlight that difference. But I think in a principle-based model that we have here in Australia, and let's not misunderstand that. I mean, some of the other speakers have spoken about how prescriptive some of the stress testing is required for lending and also insurance portfolios by our prudential regulator. That principle-based means that we have to step up as organisations, and we need to think about what is the ultimate thing about keeping all parts of our financial system accessible, available and affordable for the public. And so therefore, working together with the regulator in a principle-based model is really critical. And Tim was talking before about leadership and collaboration. Leadership is a team sport. So we have to say it might not be prescribed where, Tim will talk about in New Zealand where TCFD will be prescribed. But it's a moot point because if you're a bank or an insurer, and particularly a large one, you have to be able to comply with the regulation that's principle-based, you're expected to map your portfolios. And I know, being a director on a mutual ADI and my experience in IAG, the stress testing is a conversation with the regulator. And someone mentioned before about the ultimate thing is a regulator can put a capital impost on you, which leads to you not having a competitive advantage on how you price in the market. So there are other mechanisms there. And I think one of the things we're very clear with ASFI is let's not move away from our own responsibility as organisations and think it's all about the way you have to be regulated, because regulation catches up on topics and we have to be showing leadership on these big issues, particularly as Zoe was talking about the compounding risks. So they'd be my point, and the regulators working particularly with consumer regulators on how do we help improve risk literacy. Tim's point about pricing signals, you know, the reality is if you can't price for a risk, you can't make a risk available. And we've got the problem for decades in Wellington and far north Queensland, but you can't expect communities to subsidise other communities if the price of insurance, for example, is going up and impacting on lending availability. So we have to find a way of working with the consumer regulators to make risk literacy much more pronounced, not just financial literacy. And that might mean how pricing signals and adaptation send a signal, because people won't mitigate their risks if they think they can offload it. And so we have to do that over time and work together with our consumer regulators. That I'll hand over to Tim to talk about New Zealand.
Thanks, Jackie. Assuming I'm still audible. Yeah. Okay. Jackie makes a good point that New Zealand is politically far simpler. It's more straightforward. So we don't have interstate or even the three tiers that you have in Australia. And we also have decisions that have been made over the last 3 years and being continued on with the current government, where we have established a Zero Carbon Act to achieve zero carbon by 2050. That act carries also responsibilities for a climate change commission, which is an independently established group of experts to report, and I refer to their first report on their emissions budget, both on adaptation as well as greenhouse gas emissions. And in some ways, I think the adaptation challenge is potentially the bigger one, but they're two sides of the same coin, as we know. And then also what we are seeing is that the prudential regulator, the Reserve Bank of New Zealand, with its focus on financial stability and its focus on banks as well as insurers, who obviously provide the underwriting of the, if you like, the loan portfolio from year to year, but as Pierre pointed out, a loan portfolio that goes out 30 years. So I think changes to those terms will be interesting to see how they affect the property markets and the like. So, but the RBNZ is increasingly focusing on climate change exposures and the level of insurance that is in place, and governments have that interest as well. And I'd have to say also, wearing the international hat of the Global Federation of Insurance Associations, as we interact with the International Association of Insurance Supervisors, the prudential regulators, that they also now are having a very clear focus on climate change as one of their strategic priorities, particularly around a TCFD framework, which is becoming increasingly adopted worldwide. And of course, in New Zealand, we will be mandating the requirement to report under that TCFD framework from 2023 for companies of a certain size, but also including the public sector. Initial proposals were that it would just be privately listed companies with a strong focus on the likes of insurers and banks, but right across listed companies at a certain threshold, and also public entities, because public entities make up a large proportion of the property portfolio. So that's what's happening here. The other thing I would just quickly add is that the public-private...
Sorry, just very quickly, because we're really running out of time.
Okay, then. So our Sustainable Finance Roadmap was a public-private collective effort, and the three drivers for change around that are changing mindsets using the drivers that lead to change. So that's governance, leadership, and the responsibilities, transforming financial systems to embed sustainability into the financial system. That gets to what we've been talking about: data and disclosure, government leadership, coordination and inclusiveness, and finally financing the transformation to accelerate the transfer of capital to sustainable activities, and the likes of the TCFD reporting, standards and pathways forward are absolutely critical to achieve that.
Thank you very much, Tim. I'm going to now go to a question which takes us a little bit back to the discussion we were having around compounding risks. So this is a question for Ernst. One of the participants asked, how quickly can the analysis of insurers adapt? So they ask, we are all expecting a massive earthquake in California, but what if there is a massive earthquake in Victoria? So how quickly can the models adapt? How quickly can they be dynamic, I suppose, is the question.
Yeah, thanks, Tanya, for the question, and I hope you can hear me. I'm obviously having some troubles with my camera. It just won't turn back on or so, but I could hear you. But to your question also, well, that can be done, and that's actually really done in almost real time. Whenever we see new events coming up, we do run an analysis and see whether these new events, and that can be earthquake events, but it also can be weather-related events or hydrological events. We can see whether this matches the probabilities which we have been using so far in our models, the probabilities based on historical events. And once we realize that certain events have become more frequent, or a recent event does not match sort of the historical pattern, then we adjust our models, which are typically driven by the frequency and or intensity domain. So the reaction time is quite short in reality, as most of our contracts with our clients are renewed on a yearly basis. That is then sort of in force in the next year or so. So with this advent of these CAT models and the methodologies behind this and the science around this, I think we are quite not just flexible, but quite fast with these adjustments. And the same would apply to climate change, but most of the climate change related impacts are not necessarily acute, as we say. They're rather chronic by nature, so slow onset events, but they can be, and they are implemented.
Great, thank you very much, Ernst. Pierre, I've got a question for you here. The person's asking, how much effort or resources is it for the financial industry to evaluate physical risk? So, and in particular, is it really possible, or do we need to wait another 5 years or so for better data? And that is a question that comes up a lot, isn't it? Do we in fact need more data? Do we need better quality data?
Yeah, it's a good question. And as we alluded, I think, a little bit earlier in this discussion, it really depends how much effort you want to put into it. But what is very clear is that you can start doing things now. There is data, there is information. You don't have, perhaps, when Zoe mentioned thousands and thousands of risks to be analyzed, it might sound quite a lot, but if you ask a reinsurer, and when you look at a portfolio of a reinsurer, they've got 1,000 millions, I'm talking about millions of risks on their portfolio, and they do analyze them. So I appreciate that exercise takes a bit of time and effort, and you can't jump to the top if you're not there. However, I mean, you can start to look at the impact that could affect your portfolio on a postcode level, for instance, and appreciate how much exposure you've got on that postcode. So there are ways to address those risks or to address the impact, on portfolio. And before being very granular in the resolution, you can have an overview at a different resolution that can still give you some information on how to tackle that. So there are ways, and people are doing it now. So it's now that you have to do it.
Yeah, and I suppose the nature of these risks that we don't want to wait, do we? You have to start doing some work now. Okay, so I've got a question now for Tim. This is just the person wanted you just to recap the point that you made on the fact that risk-based pricing needs to be allowed to continue in the insurance sector.
Yeah, so the logic of this is that clearly insurance pricing is geared to reflect risk. Insurers have an obligation to all their policyholders, and that obligation is to be there for them when the worst happens. And therefore, they need to price risk in a sustainable manner. If you start to price risk below what your actual losses are, then you're not going to be around for all your policyholders when the very worst happens, when they need you the most. So if we take that principle and then apply that to climate change, by providing that risk-based signal, we're not only signaling to the property owner, but signaling to others who have a keen interest in these issues, such as developers, consenting authorities, because the world over, we have this huge problem where we build in the wrong place and we don't often build the right kind of structures, which just compound and amplify the climate change problem. So by pricing correctly and being able to demonstrate, and it has happened through the Insurance Council in Australia, where there has been the ability to provide local authorities with clear signals around what would happen if that mitigation or an adaptation initiative took place. I think the town of Roma in Queensland, or was it New South Wales, was an example of that. So insurance plays a really important role in being able to provide that price to inform investment decisions, not only investment decisions that reduce risk, but more widely applying that same approach in order to ensure that investment ensures that capital is well allocated, and therefore so we can transition to a low-carbon economy by sending exactly the right signals. As soon as we start to hide them, if we pretend, for example, that coal is not an issue around long-term investment, then we're going to go down a dark hole. So absolutely, in terms of what insurers do in terms of their investments, their underwriting decisions are ones that have to reflect that underlying risk of the unsustainability of investment in assets and activities that are going to create a less insurable and affordable world.
Thank you very, very much, Tim. Next question is for Zoe. What are your views on how to shape a long-term, say, 20-year asset portfolio in a climate risk view in a competitive environment and where so much uncertainty exists in terms of future impacts? Big question.
It's a really good question. Yeah, it's the billion and billion dollar question, really. But we were having a conversation about this actually the other day on an infrastructure panel, and collectively got to an interesting place with it. Jackie, I can't remember, you might have actually been there. But I thought it was an interesting point, and the overall point I would make is that the financial sector, or indeed the financial system, is starting to put more and more, let's say, more and more premium on investors who are able to think about things as being interconnected and systematic. and who therefore are able to anticipate risks that the rest of the financial sector will eventually elucidate to themselves before other people do. And so if you step back and you look at the exercise we're going through with climate change transition risk and with respect to physical risk now as well, as a process of kind of lifting our gaze, I guess, in the financial sector and starting to look out and see some of these initial risks and then the interconnected risks, which Jackie talked about, and also Tim talked about how it becomes a broader ESG problem. If we think about the financial sector as going through that exercise, being ahead, just slightly ahead in that process, is likely to be quite profitable in the next little while. And we can already see that. I mean, Tim's talked a fair bit about the cost of capital and some of the functions that regulators are, or the different views that regulators are taking in different regions regarding how they should respond to that change in the cost of capital that is happening as some regions go, look, we actually really want to put money into solutions. It's really important from a long run risk perspective. We don't want to fund that stuff anymore, and we'd like to do that on a whole system basis. As regulators are starting to state those preferences, and the European Sustainable Taxonomy is a really good example, and we will have a similar situation here, I'd imagine, coming out of ASFI. I won't put any deadlines on Jackie right now, but all of those efforts are basically forcing the system to see things it couldn't see before. And if you can see those things just a little bit before everyone else, then you tend to end up owning stuff that other people need to pile into. And so there is two ways to think about what's a good portfolio. You could think about what's a good portfolio in terms of what's going to be needed and what's going to get damaged. And what's going to be needed is solutions and things that help us adapt. So physical risk, response and adaptations, emergency services, healthcare, these sorts of things. Or you could also think about it in terms of what risk is the rest of the market likely to start discovering, and can I discover that first? And being able to think about the economy as a system is one of the things that people really need to be able to pursue and trace and identify that risk ahead of their competitors, basically. And so when we were talking about this in terms of infrastructure, we were talking about what solutions are actually going to be needed to make infrastructure systems work in 5 years, in 10 years. You need to be able to think about the whole system in order to figure that out. But if you can spot things that other people aren't going to see before everyone else sees them. And everyone else will see them eventually, the whole system, everyone. You know, as Peter's noted, people are working on this. There's a lot of work being done to try and build this capacity. We will get there. But if you can think systematically, you can probably get there a bit faster.
Yeah. Thank you very much, Zoe. And it's a really interesting point about seeing the whole system just slightly ahead of time. Systemic thinking or systems thinking is something that I think, especially in the finance sector, it needs to be learned. Okay, another question to you then, Pierre. Given the substantial downstream financial, economic and social implications of addressing climate change risk, how are financial institutions preparing today?
Yeah, that's an interesting one. And I'm thinking of this overall sector, as I mentioned previously, the different players of the financial sector. They do have a different way to address it. So we spent a bit of time talking about modeling, and it's true, it's definitely one aspect which can be done. But we also recognize that not everybody is doing the same type of modeling. But perhaps a more interesting point here is the way those institutions are looking at it now is very much to be informed. And not only themselves to be informed, but to pass on that information to their customers. And that's very much where the discussion is. Probably more in the banking sector, to be quite honest with you. They want to, so currently, if you want, they're already informing their customers about the value of their properties, for instance. And now what they want to do is also to bring more information to them, not just the value of the property, but also if there are incidental knowledge to be known about that property, which before was not taken into account, but now is taken into account. So the impact of climate change, but more simply, the proximity of that house to the bush, or to a river, or to the coast. So all these parameters, descriptions, environment are now integrated by those institutions, and they are thinking of a way to convey those information to the consumer. And it's obviously for the consumer also to be able to appreciate that information and to be responsible and to take a decision upon it. But it's nice to see that now they're definitely thinking on how to spread that information to the consumer, being closer to the consumer. That's very much, I'm sure you would have heard that from many sectors these days. So information is key, and exchanging information, smart information about a certain property is important. So that's very much the step that we do see now happening. And on the back of that, obviously, there might be more analytics being developed. But as I said earlier, there are different here. So data sharing is very much the key element that what is currently happening in the financial sector.
Tanya, can I add something to that?
Okay. Sorry, yes, go.
I was just going to say, I mean, Pia makes a good point there, which I think is worth just extending very briefly, which is that we think about a lot of these problems historically as being an issue of pricing. You know, do you own it? Do you not own it? Do you sell it? Is it the right price, etc.? And that's really important, as Tim has pointed out. But a lot of financial sector entities are starting to think about this not just with pricing tools, but also with communication tools with the customer, as Peter points out, but also with engagement. And so, you know, particularly on the investment side, we're all aware that engagement has just been a tool set that has basically exploded as far as risk management goes. And we initially saw that in equity type ownership arrangements where people were saying, look, I need to own everything, but if I'm going to mitigate climate change, I need you to get better. So I'm going to engage with you. I'm going to engage with the whole system in order to reduce the risk. And pricing is not my tool for that. Engagement is my tool. But we're starting to see it, and have for a while been starting to see it also on the debt side. So we have debt players who are saying, I've never got to engage before, but now I have sustainability-linked loans, and now I can actually engage. Like I can have a relationship like an equity investor used to have. And so, you know, to Pierre's point, you're seeing an additional set of tools being brought in that are not just modeling, right? And people are finding new ways to deal with it in order to sort of try and control risk across the system when they can't, you know, when the pricing's not perfect.
Got me.
You're on mute.
Okay. Well, we're just about running out of time here, but here's a question I don't know. I'll just read it out first. So other than insurance, what type of financial instruments do regulators need to focus on to encourage a dynamic and positive shift in the financial industry? And how can regulators break down the barriers to entry and make it an appealing prospect for asset finance managers and banks to adopt climate-focused products? I don't know who would like to respond to that one.
I can have a go at it, but I want to give someone else a go.
Yeah.
So I feel like I've spoken. Anyone else?
Becky, would you?
I mean, I'm sure Zoe can talk about the investment products, but I think from a banking point of view, I mean, we've started to see the evolution of green mortgages, for example. And so when you start to look at the regulator and the question about how do you actually help create that innovation around products that don't exist right now. And also, you know, I know for Community First Credit Union, our green loans for solar panels, for example, are the fastest growing personal lending products that we have. And it's at a lower interest rate, and it's also got really good credit rating and credit scoring. So I think it's about thinking about those products and the point about partnering with regulators to look at the innovation and how do you make sure the capital impost for that innovation isn't high so you can take a little bit more risk as you enter a product and start to work with the customer. And, you know, several of the panelists have spoken about getting closer and closer to the customer, and something Pierre's really emphasised. It's when you do that, you start to think about the customer life journey, what's important at that point in time. So when you're buying a house, that's the time to educate about risk, both for an insurer and a bank. It's at the time when you're looking at my energy bills are going up, what can I do to bring my energy bills down? It's not that I might believe in climate change. I do believe in climate change, but if I'm a consumer and I'm climate agnostic, then what's important to me is energy pricing. So how do I as a bank help facilitate that relationship with a customer to go for a green loan to get solar panels, for example, and to help educate about the value of that? So I think it's about being very close to the customer and their life journey, and knowing at what point can you then have the risk and financial literacy conversation that links to climate. Because if you don't do it in a way that's relevant, then you've lost the consumer, because it becomes a belief system that you're trying to fight, where you need to do it about relevance. And I think the financial instruments that regulators work with, I think it's about a product base for insurers and banks. But Zoe can talk more about investment products.
And what I guess I'd add to that is that, you know, there's been a lot of focus on investment products from regulators offshore particularly. So a huge amount of interest in making sure that investment products are either slightly pushed towards tilting in the direction of investing in system solutions and just tilting away from damage, basically, but also making sure that those products are actually properly disclosed for consumers. But I think the point that is that regulators can think about encouraging this process in products beyond the products they presently work in is the important point. Because rather than it being about any specific product, because effectively regulators can use this, and I don't want to sound too dodgy here, but regulators can use this as a backdoor way of pricing the externality. So at the moment, as an investor or a regulator, you're looking at the system and going, oh God, there's this huge risk building up over here, and I have a government that doesn't want to put a price on it, and damn. And so I've got people, as Tim has said, putting money in stuff that's risky and it's going to blow up or not be worth as much as it should be. And some of those people are households. How on earth do I get a hold on all of this? And of course, the types of tilting that we're talking about is one way that you can start to get a hold of that, which is to say, look, I can't put a carbon price in place. I'm not the right regulator. But what I can do is just tilt that cost of capital, whether it's the capital that you need to have to back it, or whether it's just straight up, you know, the cost of it, tilting it across different products, whether it's mortgages, whether it's insurance, whether it's loans for solar on roofs, is a way that you can handle that systemic risk that you're observing without needing someone else to put a carbon price across the whole system for you. And that's what we see the European Central Bank doing, and it's what we see the European Commission doing across the board, right? They're sort of saying, I need more tools than just a carbon price on my utilities and industrial sectors in order to get the system to actually take this externality into account.
Thank you very much, Zoe. And in effect, what we've been doing in the last few questions, Zoe and all of you, is really beginning to reflect on the opportunities that are also available. So, Jackie, you were talking about the opportunities that are now available, presenting themselves to banks in terms of green mortgages, etc. So, as with any form of risk, the flip side is the opportunities. So, on that note, I'm going to wrap things up and just thank you all very, very, very much for your responses to the questions, to mine, and then also to those of the questions in this webinar. And I'll hand over to you, Fiona.
Thank you. We want to first extend so much appreciation to all of our panelists and to Tanya today for your time and your expertise. We really, really enjoyed the conversation. Another thank you goes out to all of our attendees. We really hope that you learned a lot. We've sparked some conversation, sparked some ideas. We want to apologize. We didn't get to all the questions. There are quite a few questions and a lot of comments. So I just wanted to let everyone know that we will be addressing the questions and upcoming content from us and this group. And the comments that came in will be shared with all of our panelists. So again, a reminder that everyone tomorrow will be receiving a thank you email from us, and it will have the recording of today's session. We encourage you to share it with your team members, other people in your organization, share it on your social media. If you have any other questions, you'll be able to reach out to CoreLogic, and I can help connect you with anybody else post this event. But again, thanks to everybody that's participated and attended.